Hello everyone, in this video we will be doing the chapter 2 of ACCA F3 Financial Accounting, and the chapter is the regulatory framework. So before watching this video, make sure that you have watched the previous ones, and if you haven't already, you can check out the description and I have linked all the playlists. So this is a very theoretical chapter, and that's the reason why I did not cover it in the starting, because it is not practical. You just have to learn the theory. So we will just go about it in an easy manner. So have a notebook with you and make notes as I am explaining everything. And there is absolutely no practical approach here. This is just a theoretical chapter. So understand it with me. This is going to be a short video. We'll finish it in one part. So we are going to be studying about the framework, the regulatory framework in the ACCA. What are the regulators? Who are the regulators? Who is regulating all the activity? What is the framework which we are using? What are IFRS standards and everything? So this is something which we have already studied in the Business and Technology F1 examination. So we are just seeing that in a little bit of detail. So you know that whatever financial statements of a company are there, they need to match the national standards, which means they need to match what the country's laws, regulations and everything. The financial statements of a company have to match the national standards, and at the same time the financial statements of a company should also match to the international standards. Why? Because if I am in India and if there is someone in, let's say, USA, and we both want to compare a company's profile, a company's financial statements, so it should match with the international standard so that both of them can easily compare it, right? Moving on. So we'll be studying about corporate governance. So we know what corporate governance is. Okay. The regulatory framework. A regulatory framework. So why do we really need a regulatory framework? What is the purpose of regulatory framework? A regulatory framework for the preparation of financial statements is necessary for a number of reasons to ensure that the needs of the users of financial statements are met with at least a basic minimum of information. Okay. So there are various uses of financial statements. We know that. We know what the various stakeholders are, right? So there needs to be information, right? And we need to meet the needs of the stakeholders of the people. So basically the people. What are stakeholders? The people who will use our company's financial statements. To ensure that all the information provided in the relevant economic arena is both comparable and consistent. So comparable, I told you that if there is a US company and there is an Indian company and I want to compare both of them, then I want to compare both of their financial statements. So they both should be in the same format. They both should be in the same format. Only then I will be able to compare their financial statements. So that is why we are saying that they need to be comparable in nature. And the second one is consistent. So what is consistent? Consistent means continuous. So this is also something. So it should be continuous, which means you have to maintain the financial statements regularly so that there is a sort of consistency. To increase users' confidence in financial reporting process. Obviously, when you have a regulated framework, when you have a regulatory framework, when you have something which is authorized, then it obviously increases the confidence of the stakeholders or confidence of the users in the financial reporting process. To regulate the behavior of companies and directors towards the investors. So what is the main reason? Why do we need to regulate it? We need to regulate it so that the companies and the directors, meet the needs of the investors and they have a good behavior towards the investors. Easy, simple, basic stuff. Accounting standards on their own would not be sufficient to achieve these aims. In addition, there must be some legal and market-based regulations. So, accounting standards are required, no doubt about that. But along with accounting standards, we will also be needing legal and market-based regulations as well. So now let's read about what national regulatory frameworks are there for financial reporting. So let's talk about that. So what are the national regulatory framework? Keep in mind that we are doing ACCA and they speak about the UK only. There are many elements to the regulatory environment of accounting. A typical regulatory structure includes national financial reporting standards, national law, market regulation, security exchange rules. So, what is security exchange? That is nothing but the stock exchange. What is stock exchange? It is the stock market. For example, the UK has the Financial Reporting Council that issues financial reporting standards in the UK. So the FRC, what is the FRC? Financial Reporting Council. So the FRC issues the financial reporting standards. The main item of legislation affecting businesses in the UK is the Companies Act 2006. So we know what Companies Act is. We know the Companies Act 2006 and how it affects everything. However, there are many other pieces of UK, European Union and even US legislation, the Sarbanes-Oxley Act, that affect the accountability in the UK. There are also numerous industry-specific regulatory systems that affect accounting in the UK. So, there are various rules for various sectors. For the metal industry, there are various rules. For the pharmaceutical industries, there are various rules. For the education institutional industries, there are various rules. So there are various regulations to different spectrums. So that is what they are talking about. For example, the Financial Services Authority, whose aim is to achieve public accountability of the financial services industry. Finally, there are regulations provided by the London Stock Exchange. This is what we had discussed, the securities exchange for companies whose shares are quoted on the market. Okay. IFRS standards. We all know what IFRS are. We have discussed this in the PT paper. Due to the increasingly global nature of investment and business operation, there has been a move towards the internalization of financial reporting. So, due to globalization and due to all of this, we have, every country is dependent on each other, right? Due to globalization, and which eventually led to internationalization. So, because of that, we all need to be following the same format so that it is easy to compare each other's reports. This harmonization was considered necessary to provide consistent and comparable information to an increasingly global audience. So now every country and every company has a global audience. There are users from various countries, right? Times have changed. So that is why we need to have our financial statements in a format that we can compare it across states, across countries. If companies use different methods of accounting, then before any decisions can be made about different entities, the accounts would have to be rewritten so that the accounting concepts and principles applied are the same. Okay, so this is what we have discussed about consistency. Okay, so let's see the illustration. To try and illustrate the importance of harmonization, do some research on the internet. Okay, so you can read about harmonization on the net. IFRS standards are not enforceable in any country. As we will see shortly, they are developed by an international organization that has no international authority. To become enforceable, they must be adopted by a country's national financial reporting standard setter. So IFRS standards, we all know what IFRS standards are. So IFRS standards have to be adopted by countries. So only when a country's national authority adopts, only they can only then that can be enforceable. Within the European Union, IFRS standards were adopted. So we know that in the EU, in the UK is also, so the IFRS standards have been adopted. So only when your national financial reporting standard setter adopts the IFRS, only then it becomes something which is legal and which is to be compulsorily followed in your country. Other countries to have adopted IFRS standards include Argentina, Australia, Brazil, Canada, Russia, Mexico, Saudi Arabia, and South Africa. So these are the other countries who as well have um, adopted the IFRS. The US, China, and India are going through a process of convergence whereby they are updating their national standards so that they are consistent with the IFRS standards. So these countries which are here, so they are basically right now currently working on their standards. So this is the structure of the IFRS AC. What is the AC? Advisory Council. What is IC? Interpretation Council. IASB, you know what IASB is. So this is something we have seen in the business and technology paper. So now, if you could recall what IFRS Foundation is, let us see what it is. So IFRS Foundation is also called as the foundation. The foundation, so whenever we're talking about the foundation, we are talking about the IFRS Foundation. The foundation is the supervisory body for the IASB, and you know what IASB is? International Accounting Standards Board. And the IFRS Foundation is responsible for governance issues and ensuring each member body is properly funded. So, who is the supervisory body for the IASB? The IFRS Foundation is the supervisory body for the IASB. So, what is the duty of IFRS Foundation, or what is the duty of the foundation? The duty of the foundation is to ensure that each member body is properly funded. So now let's see what are the principal objectives of the IFRS Foundation or the foundation. So what are the objectives of the IFRS Foundation other than the one which we have read, that it is the supervisory body for the IASB? Develop a set of high quality, understandable, enforceable and globally accepted financial reporting standards. So developing this is also one of the biggest objective of the IFRS Foundation. Promote the use of rigorous application to take account of financial reporting needs of emerging economies and small and medium-sized entities. Bring about the convergence of national and international financial reporting standards. So these are the objectives of the IFRS Foundation, and we don't need to discuss it further because it is easy and we have also done it in the business and technology. International Accounting Standards Board. So this is the board, IASB. So let's see that. The board is the independent standard setting body of the foundation. Its members are responsible for the development and publication of the IFRS. So who is responsible for the development and the publication of the IFRS? So the IASB is responsible for this, right? So interpretations are developed by the Interpretations Committee or IFRIC interpretations. So interpretations are obviously developed by the IFRS IC Committee. What is IC? Interpretation Committee. Upon its creation of the board also adopted all existing international accounting standards. So what is IASB? IASB is held responsible basically for the publication and development of the IFRS. And what is the IFRS Foundation responsible for? IFRS Foundation is responsible for the basic foundation of and application of the standards. All of the most important national standard setters are represented on the board and the views are taken into account so that a consensus can be reached. So you need to have discussions before we pass a law, before we pass a regulation. All national standard setters can issue discussion papers and exposure drafts. So we know what discussion papers are and we know what exposure drafts are. Issued by the board for the comment in their own country so that the views of all preparers can be represented. Okay. Now let's see in the detail what the IFRS Interpretation Committee is. The IFRIC reviews widespread accounting issues on a timely basis and provides authoritative guidance on these issues. So the IFRIC, which is the IFRS Interpretation Council, so they basically provide the guidance on various issues. Their meetings are open to the public and similar to the board, they work closely with the national standard setters. Clear? IFRS Interpretation Committee, they give guidance on various issues. Moving on, we now come to the Advisory Council or the Council. So you know what Advisory Council basically is. So the Council is a formal advisory body to the board and the foundation. So to whom is it an advisory body? The IFRS Advisory Council is a formal advisory body to the board, which is the IASB, as well as the foundation, which is the IFRS Foundation. It is comprised of a wide range of members who are affected by the board's work. So let's see what the objectives of the IFRS Advisory Council are. Advising the board on the agenda decisions, informing the board of the views of the council with regard and giving others advice to the board or to the trustees. So giving other advice to the board or the trustees. So this is the duty of the IFRS Advisory Council. Okay, now let's see what is the procedure in which using which an IFRS standard gets developed. So this is also something we have done in the BT paper. So how does an IFRS standard? So what is basically a standard? A standard is basically a regulation, or you can say a law or a rule or something which comes into existence. So how does a new IFRS standard come into existence? The board identifies the subject and appoints an advisory committee to advise on the issue. So firstly the ISB finds out the issue, finds out the subject or whatever, and then it appoints an advisory committee to advise on the issue. So when the advisory committee advises on the issue, the board publishes an exposure draft for public comment. So exposure draft is given so that the public can give their opinions, can give their views, can give their comments. Following the consideration of the comments, the board publishes the final text of the standard. So we have a draft, we have an exposure draft, and when everything is met, and then we finally publish the standard. At any stage, the board may issue a discussion paper to encourage comment. So whenever in any of the stage, in any of the, in the process, the board can issue a discussion paper. The publication of an IFRS standard, so exposure draft or IFRC interpretation, requires the votes. So we need to keep in mind what are the number of votes which are required. So we require at least 8 votes out of the 15. 8 votes out of the 15. So when we get 8 votes out of the 15 members, only then the publication of an IFRS can take place. How much are they? 8 votes out of 15 members. See, these are the kind of questions that will come from this chapter, just the theory parts. Okay, now we have company ownership and control. So shareholders are who give the money to the business, right? Who is the owner? Shareholder is the owner, right? Shareholder is the owner. And who is the operating person who manages the company? It is the directors. They manage or they control the company. A company is a corporate body that has registered in accordance with the requirement of relevant national company law, the Companies Act 2006 in the UK. We all know that. Thus, by becoming its own legal entity. We know that a company has a separate legal entity than the owner, whereas in a sole proprietorship and a partnership, the legal entity is the same. There is no difference between the owner and the company. But when you're talking about a limited liability company, then we know that the business is separate from the owner. Ownership of the company is evidenced by issuing shares to the owner, the shareholders. So we all know what shares are. A company divides its a company into shares, and it helps, the shares will help raise money in the company. And if I buy shares of, let's say, Britannia, if I'm buying shares of Britannia company, then I am a shareholder of the Britannia company. But that doesn't mean I get to make decisions of their company, right? So that is what we are talking about. The difference between owners and the difference between managers or the people who control. For some smaller and medium sized companies, the owners may also be the directors and managers of the company. So, if there is an entrepreneur, so they would only be the owner, they would only be the manager, right? So, when companies are on a smaller scale, in the initial days of companies, the owner and the manager is one and the same person. It is also possible for directors of large publicly listed companies to own shares in the companies they work for. However, of the largest 100 UK companies, directors typically own less than 1% of the shares of the company they work for. Typically large listed, okay, when we talk about listed companies, what do you mean by listed companies? Where are they listed? So listed means they are listed on the country's stock exchange. So whenever a company is listed in the stock exchange, that's when we say that it is a listed company. Typically, large listed companies are owned by wide range of individuals. So we all in the share, I can go and buy a share of a company in the market. Anybody can do that. So there might be a million of owners of the company, millions of shareholders of the company, right? So that is what they are saying. That when there is a publicly large listed company, then there will be various numerous shareholders. These individuals and entities will not have any involvement in the day-to-day running of the business. That's what I told you. Just because I have a share of any company doesn't mean that they will involve me in taking the day-to-day decisions. Imagine if you had to organize a meeting of all shareholders every time the business needed to make a decision, such as hiring of a new member and everything. So it would take too long to make these decisions, and consensus might be really hard. As I told you, there are like a million of shareholders. We can't keep considering them every time we have to make a decision. It's gonna be really complicated, right? Instead, directors are appointed. Yeah. So why are directors appointed? Because directors are basically they manage the day-to-day running of the business or the operating activities of the business. Manage the business on behalf of the owners. This leads to the separation of ownership and control within the company. Unfortunately, the objectives of the owners and directors often conflict. So sometimes there are differences in opinions, right? Whilst they both might have the objective of increasing their own personal wealth. If the directors increase their own salaries and bonuses, this will reduce the profits which are available for the shareholders, right? So the directors will be rewarded for the financial success of the business. Then this would lead to a bias in the preparation of the financial statements. So this could ultimately result in reduction in reliability and credibility of the financial statements. So let's read this box. Recent history has been dogged with examples of unreliable and often fraudulent financial reporting, where directors have put their own personal interests above those of the shareholders. So, this is something which we have already studied in the BT paper. So, Enron and WorldCom are just a couple of examples, albeit very high profile ones, where directors have been convicted of manipulating published results and therefore misleading the shareholders. Okay, so there have been cases where such situations have taken place. Okay, now we all know what corporate governance is. Now let's see what the Cadbury report 1992 has said. What definition the Cadbury report has given of the corporate governance, the system by which companies are directed and controlled. So, what is corporate governance? It is basically a system using which the companies are directed and controlled. So, in the interests of shareholders and in relation to those stakeholders beyond the company boundaries. The use of the term stakeholders suggests that companies have a much broader responsibility to the economy and society at large. So, we know what CSR is, corporate social responsibility. So, the companies have to meet the needs of various stakeholders, not just their own personal monetary benefit. If directors of a company have a responsibility to these groups, then they must be held accountable to them. So they need to be answerable and they need to be accountable. Okay, now let's see what is the need for having a corporate governance. Why do we need such a framework, and what are the objectives of the same? So the basic purpose and corporate governance is to monitor those parties within a company who control the resources. So it is basically to safeguard or monitor and keep a check on how they are using the business assets. The primary objective of sound corporate governance is to contribute improved corporate performance and accountability. So for the shareholders value, so we need to meet the needs of the shareholders because we are running our company with their money, so we need to meet their requirements as well, and we need to have a good corporate performance. So let's see what the need of corporate governance is. Simply put, if the stock market mechanism is to succeed, then there needs to be a system that ensures publicly owned companies are run in the interests of the shareholders and that provide adequate accountability of the people managing those companies. The basic elements, okay, what are the elements? Effective management, effective systems of internal control, oversight of management by NEDs. Remember all this, we have done that. Fair appraisal, fair remuneration, fair financial reporting, and constructive relationship with these shareholders. So these are some things which are required in order for a business to succeed. In order to be accountable to the stakeholders of the business, the directors of a company have a range of duties. So what are the duties of the directors? A general duty is to act in good faith, so they need to behave properly and they need to act in an ethical manner to benefit the company and its shareholders. And the directors also have a duty of care, so to avoid a conflict of interest, so between the personal interest and the company's interest. So we need to manage that. What are the directors' responsibility? So these are some of the director's responsibilities which are imposed by the legal jurisdiction. So it is imposed by the law itself. So establishing and maintaining an adequate system of internal control. So we need to have a proper internal control. We have done that in the BT paper. We know that we need to have internal control because by having an internal check and internal control, we will be able to prevent any sort of fraud or malfunction which might probably occur in our business. We have a responsibility to maintain adequate accounting records. So we need to have an accounting records, properly maintain accounting records. Responsibility to prepare annual financial statements that show a true and fair view. So we know that it should be true and fair, and the financial statements prior to their publication to distribute them. So we need to distribute them and also make it available to the stakeholders. Note that in many countries, directors may incur civil or criminal sanctions. So if a director fails to fulfill his or her duties, they can incur civil and or criminal sanctions. Okay, now let's see what the UK Corporate Governance Code 2018 states. What is it? Take a moment and read it. So whatever is there in the UK Corporate Governance Code, all the companies have to follow it. And if they do not follow the code, then they have to list the reasons as to why they have not followed the UK Corporate Governance Code 2018. So the UK Corporate Governance Code, what are the 5 sections wherein it provides the 5 areas or sections where it provides governance, board leadership and the company purpose, division of responsibilities of the directors, composition, succession, evaluation of the board of directors, audit, risk and internal control, remuneration of the board of directors. So these are the things which the UK Corporate Governance Code basically checks about. Let's see what the US Sarbanes-Oxley Act really was. So in the US, corporate governance is enshrined in law, meaning compliance is compulsory. So it is in the US, the corporate governance is something which is given in their law itself. So if you fail to comply with the corporate governance, then it could lead to a criminal conviction. So what does the US Sarbanes-Oxley Act enforce? Sound systems of internal control. So the Oxley Act or the US Sarbanes-Oxley Act takes care of the internal control. Documentation, there should be a good documentation of everything. There should be evidence that management has evaluated the adequacy, evidence that the auditor has evaluated the adequacy. So what is the fundamental aim of the US Sarbanes-Oxley Act? Give me a second. Okay. So to provide the company, its management, its board, an audit committee and its owners and other stakeholders with a responsible basis to rely on the financial statements. So this is the main aim of the Sarbanes-Oxley Act, so that we can, or all the stakeholders can rely on the financial statements. So role of corporate governance, I think you can do it on your own. So that's it. We are done with the chapter. See, I told you this is a theoretical chapter. I know it can be a bit boring and it can be a little bit, tricky, but don't worry. It's going to be easy in your exam. Just practice the questions. And I have uploaded the exam kit of Kaplan also. If you haven't checked that out, you can check it in the description box below and solve the questions from the Kaplan exam kit. You can watch my video of the same. So make sure that you watch the other chapters as well, and you can check everything in the description box below. Okay, also this, just read this table as well. This is something which we have already discussed. It's not that important because it's the same thing which we have discussed. Thank you.